I'm Corbett Wall with DV Auction, here with your feeder flash for Tuesday, October the 20th, brought to you in part by VitaFirm, the best mineral your money can buy, made with Amifirm right there in South St. Joe, Missouri, and sold by my good friend David Gallagher. Trying out the expanded limits. How are we enjoying these? We never did really get to the bottom why you're seeing me cattle futures had expanded limits. I mean, we've got them now where it's enough to take you out, guys. But we enacted them earlier in the month, and we got to try them out on Monday, and it wasn't on the side that we were hoping we'd get to try out. It was on the downside, big time downside. But your limits now on live cattle, the first day that they hit limits used to be $3, now it's $4. Then after it went to $4, then after it went the limit the first day, then it used to be able to go up to $4.50. Now it can go to $6 on the second day expanded limits. And now your feeder cattle, which used to be limited at $4.50, can go to $5. We saw that on Monday. And then after the following day, after expanded limits are hit, then it can go to could go to $6.75. Now it could go to $7.50 in a one-day move. Wow. But we'll talk about your futures here in a minute, and they were very frustrating, but the board was down hard on Monday. And you think, well, why was it down? I talked around to several people. Your technicals were very bearish, and so that's one big reason that a lot of us fundamental people don't really understand. But the spots that it hits and then the lines that it makes on the squiggly graphs made people think it was going to go down. But the biggest reason is your funds are exiting the market. So we're stuck in a time right now where, especially in your cattle futures, it happens in other commodity markets too, but especially your cattle futures, the only people we have on the long side is your managed money, i.e. your funds, because as an industry we are short hedger. Your packers, in a perfect world, they would long hedge, but they're not going to do that. They get everything, all their risks taken care of by formulated contracts and the like, forward contracts, things like that. So they don't play in the market. Plus, they're not going to go long the board because that would support the market. So they're not going to do that. Nobody else much is doing any long hedging to speak of. So we're just always on a downer. And so if our funds start exiting the market, and they're pulling a lot of their money back in closer to the chest as we're getting close to the election. But open interest has plummeted. I mean, with cattle futures, we're working with a very shallow pool anyway. Your commodity markets, as a general rule, are nothing as far as size of the traded market compared to like money markets and things like that. But your cattle futures are nothing compared to grains. They're a lot more heavily traded than what your cattle futures are. And then when our open interest plummets, like it has here the last several trading sessions, and on Monday it went to the lowest on your October contracts than it's been in 4 years. I mean, just nobody playing it at all. And so whenever that happens, I mean, there's just not much left of it, and it just drops. It wouldn't surprise me, as small as open interest is, after it drops and it's oversold now, that they wouldn't get back in and run it up again, and turn it into a yo-yo deal, which we wouldn't mind the upside nearly as bad as the downside. But it's such a small pool of a traded market that if you've got a lot of money, you can pretty much make it whatever you want it to be, especially with these expanded limits. It doesn't take very long at all to take it a long ways from where it's been trading. But it's a dangerous market, guys. And I fear that a lot of the expanded limit changes here are going to take a lot of your speculators out of it. And you guys think, well, speculators shouldn't be involved in this anyway. You got to have speculators to keep the thing liquid, and that's what makes it work. It's kind of like having a few traders in some of your auction markets. You know, guys may look down on them, but you got to have traders in an auction market to guarantee that there'll be a price for everything at some point, because those guys have a little bit of trade in them. And I tell you what, I respect those guys that have some trade in them. But, you know, why are the funds taking all their money out? Because the election is coming up, and it's a very uncertain time right now with this election hovering over us, and it's likely to be pretty darn scary and kind of volatile until we get past the election. And you wonder how the election's going, and you know, you guys' guess is as good as mine. You know, they say that Trump is behind in the polls. He throws a little rally and they have 20 or 30,000 people. Biden, they say, is ahead. He throws a rally and you can haul him all the way in a school bus. It's unbelievable. I don't know how that equates, but was talking to a feeder flash listener there late last week by the name of Larry Day, and he lives in Missouri, and he told me that he'd been traveling all around the state of Missouri, state that I traveled around for many years, and I love that state of Missouri, but it's very diversified. Whichever corner you're in, it seems like you're in a different region. If you're in the Boot Hill, it seems like you might as well be in the southeast. If you're in the northeast corner of Missouri, you're in the eastern corn belt. If you're in the northwest corner, you might as well be up in Nebraska somewhere. And that's the western corn belt. And of course, down in the southwest isn't a whole lot different than Oklahoma City or the Texas Panhandle for that region, other than you have grass and water. But the people and the way they think are a lot the same. But he had told me that he is traveling all over the state and moving cattle around and making deliveries and doing this and doing that. And I said, what are you seeing out there? And he says, well, it looks to me like Biden is in fourth place behind Trump, hay, and firewood for sale. And I thought that was a pretty good analogy. You just don't see Biden signs anywhere. I don't know if the people are not proud that they support him. They don't have a yard to put a sign in or what. But and some of you guys that have complained on here that this market report has gotten kind of political. This political deal is a big deal. It has a lot to do with the markets. I tell you what, if Biden should get in, we can expect the rug to be completely pulled out of the cattle markets because of his connection with the Green New Deal and them wanting to adopt a policy that gets rid of your consolidated animal feeding operations. It's a big deal. Plus, this market report is about whatever I want it to be about, okay? And that's kind of the way it goes. I never said that this was an unbiased market report. It's completely biased. I talk about my friends, the people that I want to talk about, the markets that I want to talk about, and the subjects that I want to talk about. And that's kind of the way that goes. So if you guys, you know, are getting your feathers ruffled because you think I'm a little bit pulling towards the conservative side, yes. If it bothers you too much, you know, don't take the free click if you don't like it, because those of us that have a passion for this industry, we wear our patriotism and our conservatism right on our sleeve. And don't start challenging it, because it doesn't go very far. But you think, well, all these things, funds pulling money back, the election, you know, is it messing up all your commodity markets? No, your grains continue positive, and that's another one of the things that's hurting your cattle markets, especially your feeder cattle markets, because your grains continue to be so supportive, mostly just on the demand side, because we've got so much export demand for our grains, you know, especially to Asia there, and the prices are creeping up, but the dollar's weak, and they continue to buy it, and it's going to make it more expensive to feed cattle. But that argument doesn't go very far, because our hog prices were up big on Monday, and it's just because our cattle is such a small pool, and the open interest is down big, and it's just really easy for it to fall out. But you know, I talked about your grain markets, and we saw your crop progress report. Corn, your completion of harvest is now at 60% that come out on Monday. wow, it just seems like we got started the other day and we're already way over half done. That compares to 28% just last week. I tell you what, you didn't think they had the big heads on that thing and running them day and night. And that 60% compares to 43% same time a year ago. But you look at your beans, we're now 75% completed on beans, and you think, well, normally everybody starts corn harvest before bean harvest. Yeah, a lot of times they do, but man, can they roll through those beans. So that 75% completion, that compares to 40% that we had a week ago, and just 58%, which is your 5-year average on that. But that you know, we're buzzing through this really, really fast. But let's talk about something that's big in the cattle business. Your NCBA come out with kind of a report on how they're going to do this attempt to get a robust cattle market. You know, we went in there in the end of July, the very tail end of July, and NCBA kind of beat down our 50-14 deal. So you guys are thinking of a big announcement. You're thinking, did USDA announce something more about the investigation? No, we got the initial investigation report. It told the industry that you guys' whole system is broken. Here's how you can fix it. And one of those things was to put in a mandatory minimum negotiated cash amount there, and to push that, and to use mandatory price report to oversee that and enforce it. But NCBA thumbed their nose at that. We had a big contingent of a lot of state associations that were pushing the 50-14, but the powers that be, mostly in the Southern Plains, they struck it down and said, no, we're going to do this on our own. We're going to oversee this, and we're going to push it. So here's what they've come up with. It's called the 75% plan, or that's what most people are calling it, because there's a lot of 75% stuff going on in there. But it mostly goes back to Dr. Kuntz from Colorado State's research, which was good research, and there's no need to knock that at all. But he had some research that NCBA paid for, and he come out with minimum requirements of cash within our different areas, and then he put a minimum for robust trade. So they're basically going to turn the 5 areas into 4, because Colorado doesn't print anymore, so our confidentiality doesn't work. So for us to be able to see what's going on, so they threw Colorado in with Nebraska. Whether or not they're going to be able to get information enough through mandatory price reporting with USDA to get all this information out, we don't know for sure, but they threw Nebraska and Colorado together. But for robust trade, what they found is in Texas, we need about 9,750 head negotiated cash per week to make robust trade. Okay, we hit that a lot of times, sometimes we don't. In Kansas, they said, in Texas, they said for robust trade, we need 13,000 head. Well, NCBA plan calls to only hit 75% of that. So that comes in your 9,750 head. In Kansas, the 75% calls for 15,750 head for robust trade, or 75% robust trade, which is, I guess, what we're looking for. Now, Nebraska and Colorado, for them to reach 75% robust trade, that's going to take 27,000 head. This is all per week. And then in Iowa and Minnesota, 12,000 head is your 3/4 or 75% of robust trade. And then that's what they're going to call for, is 75% of a fair competitive trade from what they perceive it to be. Now, that's got to happen 75% of the time. So they're doing this within quarters. So 75% of the quarter, we've got to be able to hit these 75% amounts of robust trade. So it has to happen 9 out of the 13 weeks. So there's your other 75%. Also, they're saying that the packers have to participate, and all 4 packers are going to have to participate. They really don't have that spelled out yet. They're still working on that. But they're going to come up with some amount of packer participation whether that's broken down by each, all of the four competing at a certain level, or there's some packers that participate more in certain areas and some in others. I'm not sure how they're going to sort that out, and they didn't really say how they're going to sort that out, but they are going to sort out packer participation within the four areas. So then they're going to find that area, and then I assume make 75%, try to reach 75% of the packer participation that they want. So they're going to have to get more information out of mandatory price reporting that they can squeeze through confidentiality rules. Whether or not they're going to be able to get that done, I don't know. But anyway, so that's your 75%. Then they're going to put triggers in. So a trigger would be if within the quarter we had areas that certain areas didn't reach the 75% of robust trade. So if it hits a trigger, so there's actually going to be 8 triggers that it could hit. There's 8 opportunities for a minor trigger. Now that could be hitting the 75% robust trade, or having 75% packer participation, and within a quarter there. So there's 8 opportunities for that to happen. If we hit our minor triggers, and this is very confusing and it shouldn't have to be, but if we hit the minor triggers, if you hit 3 minor triggers equals 1 major trigger. So if we had within a quarter, we had Texas, it wasn't reaching your minimum amount within 9 or 13 weeks, that could be 1 minor trigger. And then if you didn't have packer participation at a certain amount, which is probably going to happen pretty regularly, that could be another minor trigger. But if you had 3 minor triggers, that equates to 1 major trigger. So then there's 8 opportunities for these triggers to happen within the trade. If a major trigger happens in 2 quarters through the year, at that point, then NCBA is going to pursue some type of legislation, some type of a regulatory move that will cause packers to participate. Wow, that is that's a scary tactic that they put in. Unbelievable how they're really getting proactive on this. Now we can get really excited about this, or we could do the 50-14 deal. But I tell you what, they've really pushed that down and got it where we don't have a whole lot of support for the 50-14 deal. But we do have the Cattle Market Transparency Act, which everybody that supported 50-14 is supporting for the most part, and a lot of other people are supporting it too. So your Cattle Market Transparency Act, the one that was introduced by Deb Fisher from Nebraska, and then we've got introduced into the House too, and we've got a lot of people signing on to it, and we've got a lot of state cattlemen's organizations that are signing on to the bill, and we need more and more to sign on their support. What it would do is it would find a minimum set, so not 50% negotiated cash trade for the whole 5-area feeding region, but it would find a suitable percentage. And I don't know if they would use the same research that the NCBA has used. I doubt it. They'll probably be a little more stringent than that. It wouldn't call for robust trade. It would call for a minimum amount that's achievable within each region, and then it would force packers to purchase that amount. Each individual packing facility within that region would have to purchase that percentage within their plant to be lawful, and they would be able to use mandatory price reporting to oversee that and to enforce it. So that NCBA deal, the 75% rule, it's something. So we really can't knock it. It's something, but it's just not nearly enough. It's not nearly what everybody wants. But I laid it out on the table. If you guys think it's a great idea, that's great. If you're like me and you think it's watered down about 82 times before it really has any bite to it, then you can think that too and get behind the Cattle Market Transparency Act. But let's look at the board for Monday. As disappointing as it is, October live cattle futures down $3.15. That's more than it could go down the first day on limits before, but all the way down to 104 even. So that just goes to show you there wasn't much play in there. They just went to one spot and drove the market to it, and it stopped at $104 even. So that was roughly $4 back what our last established market was, which was for the most part 108. December live cattle futures down 347 on the first day of limits. So now these markets can go down. They can go down $6 here on Tuesday if they want to. They could go down to $4 before, but now they can go down. They could go down $4.50. Now they can go down $6. So, but they didn't hit. Actually, they didn't hit the limit, so they won't be able to do that. We haven't hit that. Now we did have a feeder cattle month that actually hit the limit, but then it backed off of it. So they didn't close down the expanded limit, so we don't go to bigger limits yet. So if they went down $4 instead of 347, then they could go on to $6. But sorry about that. That got kind of confusing. But we're over what the limits used to be, but that we didn't close down the limit, so we don't have to worry about additional expanded limits yet. But December down 347 at 105.15. You go out from there on your live cattle futures, they were down $2.02, your furthest one out, to down $3.40. But a lot of stuff about as clear as mud here. October feeder cattle down $3.50 there. It could always go down 3.5, or not always, but in the limits that we previously had, it could go down that much. But down $3.50 at 134.60. November down $4.95, so that's bigger than it ever went down before. And November contracts actually were down the new $5 limit for a time, but then they backed off of it at the close, so they don't go to expanded limits yet either. But down $4.95 at 130.07. You go on your out fronts on feeder cattle, they were down $2.90 to 4.10. Okay, weighted average on last week's negotiated cash market in your 5-area feeding region on 92,500 head. Decent movement. We like to see it over 100,000, what I consider robust. And 92.5 compares to 96,100 the previous week, and only 63,100 the same week a year ago. But cash sales, live sales, steers and heifers were $1 lower, from 105 to 109, with a weighted average on live steers at 107.52. That was 74 cents lower than the live steer weighted average from the previous week. Dressed steers and heifers sold from 165 to 169. That was $1 to $3 lower. But your weighted average on dressed steers was 168.35, down $1.32. So nationwide, we had negotiated cash sales of 111,100 head. We had formula sales nationwide, 282,000 head. Therein lies our problem, guys. That's what we're all been talking about. 282,000 cattle selling off what 111,100 head brought for the most part. Negotiated grid, which is another thing that the NCBA, some of the people there think is going to save the world, was only 21,600 head nationwide, which is nothing. But of your negotiated cash trade nationwide, 111,100, roughly 38,000, or about 34% of that was for time, 15 to 30 day delivery. So kind of setting us up a little bit there. We had trade on Monday, guys. Iowa sold 1,100 head from as low as 103 to mostly 105 and 166 dress. So we've already lost, $2 to $3 in the market. We haven't really got it established yet, and I wouldn't think so. Southern Plains is almost established, but Nebraska 2,500 head confirmed on Monday. Just some mixed bag junk at 105. And then 165 dressed. But Kansas and Texas sold significant amounts of cattle at 106. Your market in the Southern Plains is 106, $2 lower. If the board continues lower again on Tuesday, I would seriously doubt you could get that. But Kansas sold 4,200 head, Texas sold 6,500 head there. Let's talk about feeder cattle markets. Real-time index on DV auction late in the day on Monday, 137.67, down $1.40. Your big sales on Monday. Oklahoma City, Oklahoma National Stockyards, 6,800 head there. Feeder steers $3 to $8 lower. Feeder heifers $1 to $5 lower. Calves were steady to $3 lower. If you listen to Bailey Blue, like I do a lot of times, he does a video market report for Oklahoma City, and he was talking, they get started early there about 8 o'clock, and he said, you know, they had a good crowd there, and cattle were actually selling a little bit better until the board opened, and then it opened lower, and then it crashed. And he said then it really fell out of bed. But it was very frustrating for him to be there supporting that market, and him as an auctioneer. It gets to the point where it's just really tough selling cattle whenever you have that many people pulling back. And you hate to just drop the cattle down to nothing to get them sold. But I tell you what, tough deal there in Oklahoma City on 68 to 100 head, and it was tough everywhere. Joplin Regional Stockyards, 4,800 head there. Yearling feeders, my good friend and former co-worker Rick Huffman called those $3 to $8 lower on yearling feeder steers. That's tough, guys. Yearling's been selling really good, but called calves $7 to $12 lower. Said most of the calves on hand were unweaned. And most of those would not have had any shots. If they would, they probably just had a black leg or something. But tough markets around, guys. And I've told you, you get in these sales all over the country. They last late into the night. The orders have been filled, and there's still lots of small bunches of unweaned calves with no shots, with no home. And the market just completely falls out of bed on them. How about Faith, South Dakota? Faith Livestock Auction had over 7,000 head of feeders there. Looked at the automated market report because that's the only one they have. It was steer calves were $2 to $7 lower. Heifer calves $2 to $9 lower. You look at the weighted average on the best tested weights there. On steers, they had almost 2,750 head of 5-weight steers in Faith, South Dakota, and they would have all been plenty good, guys, to go anywhere, with a weighted average weight of 547 pounds, and all those 5-weight steers had a weighted average price of $157.16. Sounds pretty good to a lot of you guys, but that was almost $4 lower, $3.50 to $4 lower. On the heifers, they had 1,132 head of the 5-weight heifers, averaged $535 with a weighted average price of $143.25, and that was straight up $2 lower on the weighted average price there. But still selling calves pretty darn good on individual quotes with reputation. You look at this quote out of Faith, South Dakota, 155 head of steers, one whack, 418 pounds, bring 191.25, and I did notice that happened after the board closed, so it didn't completely knock everything out of bed. Some other individual quotes I thought were impressive around on Monday. Aberdeen livestock sales, Aberdeen, South Dakota, 62 head, 933 pound steers bring $141, but the big quote comes out of Sioux Falls Regional Livestock, Worthing, South Dakota, for one whack. Look at this big deal of steers. 380 head in one drive, 855 pound steers bring $141.25. And that's your feeder flash for Tuesday.